Hi guys, we're getting started on a new part of our accounting equation today. I wanted to show you a few things in the module before we started our assignment. But if you go to the module for October the 8th and you look down to Expanded Accounting Equation, it's under the title Joining the Pieces. The Expanded Accounting Equation is a page that is in here. It will open up for a preview. And you see that the expanded accounting equation is illustrated here. Remember, your accounting equation is assets equals liabilities plus owner's equity. But today it's been expanded to plus revenue minus expenses, because if you remember, anything in the income statement that we did, remember we prepared the income statement first and then we prepared the statement of owner's equity. So revenue and expenses, or the items that belong on the income statement, impact owner's equity. That's why they are shown along with owner's equity in the expanded accounting equation. So let's review what these are. Remember, assets are anything of value that is owned by the business in order to operate, like a car. Liabilities are debts owned by the business, like your car payment. Owner's equity is the difference between the assets and the liabilities. What you own minus what you owe is your owner's equity. And also, revenue is the inflow of assets, usually cash or accounts receivable. This is your sales that you have during the course of your business. That's called revenue. And then your expenses are the expenses that you incur in order to do business. And your book defines them as costs necessary to operate the business. And down below here, it gives you examples. For example, rent expense, salaries expense, repairs expense, utilities expense. Back on revenue, you see there's any kind of revenue or fees earned, rent income, but this is the income of the business. The owner's equity is also called capital or net worth or perhaps even proprietorship. Your liabilities, common liabilities, accounts payable, remember that is things that people owe you that are going to be paid at a later date. Accounts payable are things you owe that you are going to pay at a later date. Remember, payable, that's something you are going to pay. So accounts payable, notes payable, taxes payable, that's something you owe, that's a debt. Now, back here on assets, examples are cash, accounts receivable, supplies, equipment, buildings, land. Those are things that you own and have value. So, an accounts receivable, I boo-booed just a second ago, I gave you that definition as for accounts payable. But accounts receivable are things that people owe you. For example, you sold them something on credit and they're going to pay you later. So accounts receivable is money you are going to receive. All right, then you have owner's withdrawals and the removal of assets from the business for the personal use of the owner. Remember, and it's also called drawing. It is money that the owner is taking out of the business for their personal use. Now, if you spend something for the business, it's an expense over here. But if it's for personal use, it is a drawing or a withdrawal. So you'll find those here. And if you draw out cash, for example, the owner takes $100 out, you're going to decrease cash, or that's the asset taken out, and then you're going to decrease owner's equity because you have reduced the amount of money the owner has in the business. Now, given that, keeping that in mind, I'd like to go back and look at another thing. going to take you to the next page here. And the next page is kind of an overview of what we will be doing today. This is called summarizing the transactions, but this is in an expanded accounting version. And you see you have your assets equals liabilities plus owner's equity. That's your accounting equation. But here's the expanded one. In this instance, we are going to use, we've broken down the assets into cash, accounts receivable, supplies, and equipment. Okay, those are all assets. Equals your liabilities, which your only liability in this instance is accounts payable, plus owner's equity. Now your owner's equity for here is your capital account plus any revenue minus any expenses. So this, we're going to take some transactions today and we are going to display them in an expanded accounting equation form. So here is a set already done for you, and I'm going to just walk through them very briefly. For example, your transactions will be listed on the left side. They'll be identified by either numbers or letters, and in this case they're letters. And after each transaction, you're going to see a balance because you want to balance the account because you want to know how much is in the account after every transaction. So, starting out, transaction A, cash is increased $20,000 and Marilyn Johnson capital is increased $20,000. See the plus signs. And the description here is investment. So Marilyn Johnson began her business. She put $20,000 of her own money into the business. So you see that increases cash because she put $20,000 in, and it also increases her capital. Now, it doesn't impact any of the other accounts here because it was just that one transaction. And you will only enter numbers into what the transaction is. Since that is our very first transaction, we don't have a balance after that one. But now we will add transaction B, which is an equipment purchase. Now, the equipment purchase, if you look at the accounts, it was on credit, because you see cash was not impacted. But equipment was increased because you bought equipment. So you increased equipment, that's an asset, and then you increased your debt, your accounts payable, because you have to pay for the equipment. You didn't pay cash, but you're going to pay for it later. So you created a liability, and you see that it increased there. So now we will have a balance, and you see cash has a balance of $20,000, equipment has a balance of $30,000, liabilities have a balance of $30,000, and capital has a balance of $20,000. Now remember, keep in mind where your equal sign is, and this is just like math class. What you do to one side of the equation, you have to do to the other side because you have to keep it in balance. So if you do something over here, unless you have offsetting increase and decrease on the same side of the equal sign, you'll have to do the same thing on the other side of the equal sign. So you notice here, cash increased $20,000, which is an asset on this side of the equal sign, and then equity or capital increased. So your accounting equation is still in balance. Same thing here. Assets increased, liabilities increased. Your equation is still in balance. Now, if you look here, you made a supply purchase. You purchased supplies for cash. This is C. Well, if you purchased it with cash, you have to reduce cash. So you're going to subtract $2,000 from cash, and you are going to increase supplies because you purchased supplies, and supplies is an asset. Now notice in this transaction, it all takes place on this side of the equal sign. So you don't have anything on the other side. The transaction, the equation is still in balance because you subtracted and you added on the same side of the equal sign, and it's the same amount. So then again, you'll have a balance. Now the next transaction, you paid or you got legal fees because Marilyn Johnson is an attorney. So Marilyn Johnson performed some legal services and she received cash. Well, you increase revenue and then you increase cash because she received cash for the services. And it will tell you in the transaction how the legal fees are received, if they're cash or on account. So they're cash, so you're going to increase cash, and then you're going to increase legal fees. Notice they're on opposite sides of the equal sign, so they're still in balance, and then you are going to do a balance for each account. The next one, E, you paid salaries, and you paid cash. Excuse me. So you see you reduced cash by $1,500. You increased expenses by $1,500 because you incurred expenses for salaries. And you will see that this is increased, this is decreased. Now, the reason you increase here is you're subtracting an expense. So this is actually, if you do your expanded accounting version, you are subtracting here and you are subtracting here because you are subtracting expenses. You have to add it here just because you're accumulating an amount of expenses. So keep that in mind. But your transactions are still in balance because this will be $1,500 on this side and $1,500 on this side. Okay? Transaction F is you paid on account. You're paying off, or you're paying on your equipment because that's your liability. So you've paid $5,000. You're decreasing cash because you're paying $5,000, and you're also decreasing your liability because you're making a payment on your debt. So you're decreasing your debt. So, and your transaction is still in balance. On withdrawal, looks like the owner took $700 out of the business for personal use. So you subtract from capital because she is taking it out for her personal use, and that will reduce her capital. You're also reducing cash, and then you have a balance after this transaction. The next one is legal fees, like the one before. You received cash for legal fees, so you have increased cash, you have increased revenue. And then you will do that for each one. This one, you've paid 2 expenses. And if you pay 2 expenses in one transaction, you want to always show them separate. You don't just want to lump it all together and say $850. You want to show, if it's utilities, $250, and rent, $600, you want to show them separately because of showing them. You want to make sure that you record them properly for accounting purposes. And you'll also show them separately here in cash because you've paid cash for them. Again, here's legal fees, but this time the legal fees were on account. So instead of increasing cash this time, you will increase accounts receivable. And the last one is you received payment on account. So the client who she did work for legal fees for in the previous transaction is paying $300 on their account. So she is increasing cash and decreasing the amount that she's going to be owed, or the receivable. Notice this is still in balance because it's on the same side of the equal sign. So just make sure after every transaction, what you do on one side, you need to do on the other.